Welcome back to the Deep Dive. Today we're tackling something that, let's be honest, can feel a bit daunting.
Mhm.
Tax forms. Specifically, we're diving headfirst into one that often makes people groan a little. Schedule B.
Yes, Schedule B, interest, dividends, foreign accounts. It sounds dry, maybe.
Exactly. You hear taxes and fascinating in the same sentence and think, are you serious? But honestly, stick with us. Once we, peel back the layers, there's more here than just rules.
Absolutely. There are actual opportunities to make sure you're not paying more than you need to.
And getting your financial picture clear for the IRS, which is always good.
That's really it. What's fascinating, I think, is how these little lines and boxes on Schedule B can actually ripple out and affect your whole tax situation.
So that's our mission today.
Pretty much.
Yeah.
Let's demystify these IRS instructions. Make Schedule B make sense. Show you where your interest, your dividends, those foreign holdings, where they all fit.
And crucially, find those spots where you can, maybe, minimize your taxable income. Legally, of course.
Of course. It's about connecting the dots.
Yeah.
Seeing how this one form fits into smart, efficient financial reporting overall.
Okay, so the goal is simple. Turn this IRS headache into something actionable. A guide just for you. We'll focus on reporting accurately, yeah, but also spotlight those strategies, those maybe overlooked rules that can save you money.
It's about being informed, feeling prepared, maybe even a little empowered come tax time.
Couldn't have said it better. Let's jump in.
Yeah.
All right, so let's start with the absolute basics. The question on everyone's mind. Do I even need Schedule B? Because it's not automatic, right?
That's the perfect place to start. No, it's definitely not for everyone. The most common reason you'd need it is pretty straightforward.
Okay.
Did your total taxable interest or your ordinary dividends from all your sources combined add up to more than $1,500 for the year?
$1,500. That's the magic number then.
That's the main threshold, yeah. And when we say taxable interest or ordinary dividends, think about those forms you get in the mail. Your 1099 INT from the bank, maybe a 1099 OID, a 1099 DIV from your investments.
Right, those ones.
Add up the taxable amounts on all of those. If that total is over $1,500, boom, you need Schedule B.
Okay, so if I just have, say, one savings account, maybe $50 interest, and a tiny bit of stock, maybe 100 in dividends, I'm probably clear.
Likely, yes. If you're well under that $1,500 combined total, you probably don't need Schedule B just for that reason.
But knowing taxes, there are always exceptions. Other ways Schedule B might sneak into my life, even below that $1,500.
You nailed it. There are definitely other specific situations that force you to file Schedule B no matter the dollar amount.
Like what? Give me an example.
Okay, one is a bit niche but important: seller-financed mortgages.
Meaning I sold property and acted like the bank.
Exactly. Maybe you sold a second home or even your main home, and the buyer pays you interest directly, not a bank. And crucially, they're using that property as their personal residence.
Okay.
If that's you, you have to report that interest on Schedule B. And here's the kicker, the really important part.
Yeah.
You must list the buyer's name, their address, and their social security number right there on the form.
Why? What's the logic there?
It's all about transparency for the IRS. They want to match your interest income with the buyer's potential mortgage interest deduction. Make sure both sides line up.
Connecting the dots.
Precisely. And if you don't provide that info, there's a $50 penalty. So it's not just about your income. It's about giving the IRS the info they need to verify the whole transaction.
Creates that clear audit trail. Got it. What else? You mentioned bonds earlier. They always seem to have their own rules.
They absolutely do. Another trigger for Schedule B involves accrued interest from bonds.
Accrued interest, meaning interest that built up before I actually bought the bond.
Exactly. You buy a bond between its regular interest payment dates. Part of the price you pay is usually to reimburse the seller for the interest earned since the last payment but before you bought it.
Okay, I pay the seller for that bit.
Right. Now, that interest, it's actually taxable to the seller, not you. But sometimes the full interest payment later comes to you, and it might all show up on your 1099.
So I'd look like I earned it all.
Potentially, yes. Schedule B is where you fix that. You report the total, then subtract out the accrued interest you paid, so you're only taxed on the interest earned while you owned the bond.
That's a subtle but really important adjustment. You're basically correcting the record.
You are. It's aligning the tax form with the economic reality. Same idea if you're dealing with original issue discount or OID.
Okay, OID.
Yeah.
Remind me what that is again.
Think of it like interest paid up front. You buy a bond for less than its face value, say $900 for a $1,000 bond. That $100 difference, the discount, is OID. It's treated as interest income over the life of the bond, even if you don't get cash payments. Now, if the OID amount you calculate you need to report is less than what's on your Form 1099 OID, maybe because you bought it in the market and paid a premium over its adjusted price, Schedule B is where you explain that difference.
So you use it to show the IRS, hey, the 1099 is high for this reason.
Exactly. And the flip side is amortizable bond premium, or ABP.
Okay, premium means I paid more than face value.
Correct. You buy a taxable bond for, say, $1,100 when it matures at $1,000. That extra $100 is the premium. The IRS lets you amortize that premium, meaning you can reduce the taxable interest you report each year by a portion of that premium. It brings your taxable return closer to your actual lower yield to maturity because you paid extra upfront.
And Schedule B is how I claim that reduction.
That's the mechanism, yes. You use Schedule B to make that ABP adjustment.
Okay, these bond adjustments sound, well, critical for accuracy. And maybe save some tax money, too. Are there other direct tax-saving things that trigger Schedule B?
Definitely. A really good one is the exclusion for interest on certain U.S. savings bonds, specifically Series EE or Series I bonds issued after 1989.
Ah, the education savings bonds.
Those are the ones. If you cash those bonds and you paid qualified higher education expenses for yourself, spouse, or dependents in the same year,
Yes.
you might be able to exclude some or even all of the interest you earned on those bonds from your income. It's a direct tax benefit.
Wow. So even though it's an exclusion, I still need Schedule B.
Yes, because you use Schedule B, specifically Part Y, to show the IRS you're claiming this benefit. It highlights that the form isn't just for reporting income, but also for claiming these specific beneficial adjustments and exclusions.
That's a great example of using the form proactively. What about situations where the money isn't really mine? Like it passes through my account, the nominee thing.
Yes, the nominee situation. This is absolutely crucial for avoiding tax on income that doesn't belong to you.
How does that work?
Okay, imagine you received interest or dividends and it's recorded under your name and social security number, maybe because you're a custodian on an account for a child or holding assets for someone else.
But the money isn't beneficially mine.
Exactly. You're just the nominee. In that case, you must use Schedule B. You report the full amount you received, but then you subtract it back out, labeling it as a nominee distribution.
Ah, so it nets to zero for you.
For that portion, yes. It ensures the income doesn't stick to your tax return inappropriately. Very important to avoid phantom income issues.
Makes total sense. Pay tax on what's yours, not what isn't.
Yeah.
Okay, one last trigger you mentioned. Foreign stuff. Foreign accounts. That sounds complicated.
It adds another layer for sure. The last main reason you'd need Schedule B is if you had a financial interest in or signature authority over a financial account in a foreign country, or if you dealt with a foreign trust in specific ways.
We'll dig into that more later, I assume.
Oh, yes. That part 3, is less about income calculation and much more about crucial disclosure and compliance. The penalties for getting that wrong can be quite severe, so we definitely need to unpack that carefully.
Okay, wow. So Schedule B isn't just about hitting that $1,500. Any of these other situations, seller financing, bond adjustments, savings, bond exclusions, nominee status, foreign accounts could pull you in.
That's the key takeaway. Always check for these specific conditions.
Got it. And hey, here's a quick practical tip before we move on, especially if you get a stack of 1099s.
Yeah.
For listing interest on line 1 or dividends on line 5, you don't always need a separate line for every single bank or broker.
Oh, right. Yeah.
You can actually list multiple payers on one line. Like you could write First Bank, Second Credit Union, Brokerage XYZ, and then put the total interest from all three right next to it. Or show the breakdown. First Bank, $500, Second CU, $700.
As long as the total is clear.
Exactly. Just make it clear. And if you have like tons of accounts run out of space on Schedule B itself.
Don't panic.
Right. Just attach a separate statement. But, and this is important, make sure that statement uses the exact same format as the lines on Schedule B. List the payers, the amounts, show the totals clearly.
And
always put your name and social security number on any attachments you send in. Helps the IRS keep everything together. Simple tip, but can save hassle. Okay, now that we know who needs Schedule B and why, let's dive into the real meat of it. Part 1, interest. This is where you list all that taxable interest, right? But it sounds like there's more to it than just copying numbers from a 1099.
That's absolutely right. Line 1 is your starting point. It's where you report all your taxable interests. And yes, generally, the primary sources for this are your forms, 1099 INT, maybe 1099 OID, or similar statements from banks, brokers, etc.
So basic savings account interest, CDs, money markets.
Yep, all that. Also, interest from U.S. savings bonds, those series EE, HHH, and I bonds we mentioned, plus some more complex things like accrued market discount you have to include in income, or certain gains on tricky debt instruments that get treated as interest.
Okay, lots of potential sources. But what's the big thing not to put on line 1?
Crucially, do not put tax-exempt interest here. That belongs somewhere else entirely. Line 1 is strictly for the interest the IRS considers taxable income.
Got it. Taxable only. But this is where those adjustments come in, the ones that can actually lower the amount you report, potentially saving tax.
Exactly. This is where knowing the rules pays off. Let's talk about that surprising one first. Market discount on tax-exempt bonds.
Right. The one that sounds like it shouldn't exist. Tax-exempt bond, but taxable interest. How?
Okay, imagine you buy a municipal bond normally tax-exempt on the secondary market, but you buy it for less than its stated redemption price. Say you pay $950 for a bond that will mature at $1,000.
To get a $50 discount.
That $50 is a market discount. Now, even though the regular interest payments from that muni bond might be tax-free, that market discount, when you eventually get it back, either at maturity or if you sell the bond, is generally considered taxable interest income.
Whoa. Okay.
So you'd need to report that portion of the gain as interest income on line 1 of Schedule B. It catches people off guard, but it's how the IRS taxes the economic gain from the discount itself. A key thing to watch if you trade munis.
That is a hidden wrinkle. Okay, what about those seller-financed mortgages again? How does reporting that look on line 1, and what's the impact of getting it right?
For seller finance mortgages, when you're getting interest from the buyer of a property they use as their home, you list that interest amount on line 1. And right next to it, you include the buyer's name, address, and SSN.
We mentioned the penalty for not doing that?
Right, the $50 penalty. But doing it correctly is also about facilitating the whole system. It allows the IRS to easily cross-reference your income with the buyer's potential deduction. If you or the buyer lacks an SSN, use the appropriate TIN. It ensures transparency.
So providing that extra info is key for compliance. Now let's get back to those adjustments that directly cut the taxable amount. Nominee distributions. How exactly do I use that to avoid tax on money that isn't mine?
This is such an important one. So you get a 1099 INT. It's got, say, $1,000 of interest listed under your SSN, but $400 of that actually belongs to your child, maybe from a custodial account.
Okay.
First step. On line 1 of Schedule B, you report the full $1,000 shown on the 1099. Don't just report the $600 that's yours.
Report the whole thing first. Got it.
Then you subtotal all the interest listed on line 1. Right below that subtotal line, you write the words nominee distribution. And next to that, you put the amount that wasn't yours, in this case, $400.
Okay, clearly label it.
Yes. Then you subtract that $400 from the subtotal. The remaining amount, the $600 that is yours, is what goes on line 2. That's your actual taxable interest from this process.
That makes sense. Report it all, then back out what wasn't yours.
Precisely. But, and this is the other side of the coin, if you're acting as a nominee, you generally have an obligation. You need to issue your own Form 1099 INT to the actual owner, unless it's your spouse.
Ah, so I had to file a 1099 too.
Yes. You file that 1099 INT with the IRS, along with the Form 1096 summary. This makes sure the IRS know who the income actually belongs to, so they can expect to see it on their tax return. It completes the chain.
Okay, that ensures the right person pays the tax. What about the accrued interest situation when buying bonds? Similar adjustment.
Very similar mechanism. Remember, you bought a bond, paid the seller for interest accrued before you owned it. That interest is taxable to the seller.
Right.
If your 1099 includes that interest anyway, you handle it just like a nominee distribution. Report the total interest from the 1099 on line 1, subtotal. Then below the subtotal, write accrued interest and the amount you paid the seller. Subtract it out.
And the net amount is what's actually taxable to me.
Exactly. It prevents you from being taxed on interest earned by the previous owner. Again, aligning the tax form with reality.
These adjustments seem crucial for bond investors. What about the more complex ones, OID and ABP adjustments?
Right. Original issue discount OID adjustments. Let's say your 1099 OID shows $500 of OID, but you calculate correctly that you only need to report $450. Maybe because you bought the bond at an acquisition premium, paid more than its adjusted issue price.
Okay, so my actual taxable OID is lower.
If that's the case, you use the same subtraction method. report the $500 from the 1099 subtotal, then write OID adjustment and subtract the $50 difference.
But there was a warning here, right?
Yes, a very important one. No reduction is allowed if the payer, the institution that issued the 1099 OID, has already reported a net amount of OID. Sometimes they factor in the acquisition premium for you on the 1099 itself. Check the form carefully. You can't subtract it again if they've already done it.
Got it. No double dipping on the adjustment. And for amortizable bond premium, ABP. Same idea.
Same idea, same mechanism. You bought a taxable bond for more than its face value, the premium. You elect to amortize that premium to reduce your taxable interest income each year.
A direct tax saver.
It is. So you report the gross interest from your 1099 INT on line 1, subtotal, then write ABT adjustment and subtract the amount of premium amortized for that year.
And the same warning applies.
Absolutely. No reduction is allowed if the payer has already reported a net amount of interest income on the 1099, meaning they've already subtracted the amortizable bond premium for you. Again, check your 1099 carefully to see if they netted it out.
Okay, so the theme here is use these adjustments to correct the record and potentially lower your tax, but be very careful not to double count if the payer already did some of the work.
Perfectly summarized. Now let's switch gears slightly. Tax-exempt interest. Where does that go?
You said not on Schedule B, line 1.
Correct. Tax-exempt interest gets reported directly on your main tax form, the Form 1040 or 1040-SR, usually on line 2A.
Why report it at all if it's tax-exempt?
It's mostly informational for the IRS. It doesn't increase your taxable income, but it can affect calculations for other things like the taxability of Social Security benefits or certain credits and deductions that have income phase-outs. So they want to know about it.
Where do I find this number?
Typically, Box 8 of your Form 1099 INT, or sometimes Box 11 of Form 1099 OID for tax-exempt OID. Also, Box 12 of Form 1099 DIV often shows exempt interest dividends from mutual funds.
Okay. Any tricky parts here, even though it's tax-exempt? Any savings angles?
Yes, there's a nuance, especially with bonds bought at a premium. If you bought a tax-exempt bond at a premium, you should amortize that premium, similar to taxable bonds, but the rules differ slightly. When you report the tax-exempt interest on Form 1040, line 2A, you report the net amount.
Meaning interest received minus the amortized premium for the year.
Exactly. So you're showing the IRS a lower amount of tax-exempt income, which more accurately reflects your economic return and could be beneficial for those other income-sensitive calculations. Same idea applies if you bought a tax-exempt OID bond at an acquisition premium report, the net OID.
Interesting. Not reporting even for tax-exempt. Good to know. What about that Box 9 on the 1099 INT?
Yes, Box 9. If there's an amount there that usually relates to specific types of tax-exempt interests, like private activity bonds that could be subject to the alternative minimum tax, or AMT. That amount generally needs to be reported on Form 6251, the AMT form, on line 2G, something for higher income folks to watch.
Okay, AMT implications. Got it. Now, finally, for part 1, let's revisit that Series EE or I savings bond interest exclusion on line 3. This sounds like pure tax savings.
It absolutely is, and it's often missed. Line 3 is specifically for claiming this exclusion. Remember the conditions.
Bonds issued after 1989, cash them. Paid for qualified higher education expenses.
Perfect. Yourself, spouse, or dependent. If you meet those criteria, you might get to exclude some or all of the interest earned on those bonds from your income. It just vanishes tax-wise.
And so I know how much I can exclude.
For the exact calculations, income limits, and what counts as a qualified expense, you need to fill out Form 8815, Exclusion of Interest from Series EE, and U.S. savings bonds issued after 1989. That form walks you through it. The result from Form 8815 then goes on Schedule B, line 3, effectively reducing your taxable interest.
That is a fantastic tax-saving nugget for people paying for college. Definitely worth checking Form 8815 if you cash those bonds.
Absolutely. It's a prime example of how understanding these specific lines can directly lower your tax bill.
Wow. Okay, so Part I is way more than just listing interest. See how many chances there are to make sure you're only taxed on what's truly yours, to correct errors on 1099s, and even to claim specific exclusions like the savings bond one.
It really underscores the importance of not just taking the 1099s at face value. Digging into the details matters.
These adjustments feel like finding hidden treasure buried in the tax code. Small details, potentially big impact on your bottom line. All right, let's move on. Part 2 of Schedule B deals with ordinary dividends. This section often feels a bit simpler, doesn't it? Fewer adjustments, maybe.
Generally, yes, it can seem more straightforward. Line 5 is the main reporting line here. This is where you list all your ordinary dividends.
And where do I find that total?
Primarily, you'll get this number from Box 1A of your Forms 1099 DIV or similar substitute statements from brokers or mutual funds. Just add up Box 1A from all your 1099 DIVs, and that total goes on line 5.
Okay, Box 1A. Seems simple enough, but
Yeah.
I'm guessing that nominee distribution rule pops up here too, if I got dividends that belong to someone else.
You guessed right. The principle is exactly the same as with interest, and it's just as important for making sure you don't pay tax on someone else's income.
The same process.
Identical process. If your 1099 DIV includes ordinary dividends that you received as a nominee, first, report the total ordinary dividends from Box 1A on line 5. Include the nominee amount initially.
Okay.
Then subtotal everything on line 5. Below the subtotal, write nominee distribution and the amount of dividends you received as a nominee. Subtract that amount.
And the result goes on line 6.
Exactly. Line 6 will show the net ordinary dividends that are actually taxable to you. And, just like with interest, the obligation is there. You generally must issue a Form 1099 DIV to the actual owner, unless it's your spouse, and file the 1099 DIV and Form 1096 with the IRS.
Completing the chain again. Making sure the income lands on the right tax return.
Precisely. That nominee adjustment is key for dividends, just as it is for interest.
Okay, so the nominee rule is the big adjustment here. But while we're talking dividends, the 1099 DIV form itself has more boxes than just Box 1A for ordinary dividends. Do those other boxes matter for Schedule B, or are they handled differently? Because understanding this could mean tax savings, right?
That's an excellent point, and yes, understanding the whole 1099 DIV picture is crucial for tax efficiency. Even though only ordinary dividends go directly onto Schedule B Part 2, the most important distinction is qualified dividends.
Right, I hear that term a lot. They're taxed differently.
Yes, significantly differently. Qualified dividends are typically found in Box 1B of your 1099 DIV. While they are part of the ordinary dividends total in Box 1A, qualified dividends are generally taxed at the lower, more favorable long-term capital gains tax rates.
Ah, so much lower rates than regular income for most people.
Exactly. This is a major potential tax saving. You don't report qualified dividends separately on Schedule B, but you do report them on your main Form 1040, where they get that preferential rate. Knowing the difference between ordinary Box 1A and qualified Box 1B is vital for calculating your tax correctly.
What makes a dividend qualified? Is it automatic?
Not always. There are holding period requirements for the stock, and the dividend must be paid by a U.S. corporation or a qualified foreign corporation. Your brokerage statement or the 1099 DIV usually indicates which dividends are qualified, but it's good to understand the basics.
Okay, so Box 1B is key for lower tax rates, but doesn't change Schedule B itself. What else might be on that 1099 DIV?
You might also see capital gain distributions, often in Box 2A.
Where do those come from?
Usually from mutual funds or REITs. It's when the fund sells assets within its portfolio at a profit and distributes those gains to shareholders.
Is that a dividend? Does it go on Schedule B?
No and no. Even though it's on Form 1099 DIV, it's not a dividend. It's treated as a long-term capital gain. You report these on Schedule D, capital gains and losses, where they also typically get the lower capital gains tax rates. Big difference from ordinary income.
Okay, so Box 2A goes to Schedule D, not Schedule B. What about Box 3? Sometimes there's a number there.
Good catch. Box 3 shows non-dividend distributions, also often called a return of capital.
Return of capital, meaning the company is just giving me my own investment money back.
Essentially, yes. It's a distribution made by the company that is not paid out of its earnings and profits. And here's the key. Return of capital is generally not taxable income when you receive it.
Not taxable at all.
Not immediately. Instead, it reduces your cost basis in the stock. So if you paid $50 per share and you get $2 per share as a return of capital, your new basis is $48. It affects your gain or loss calculation only when you eventually sell the shares.
So it defers the tax impact until sale.
Right. The only time a return of capital becomes immediately taxable is if the distribution exceeds your entire cost basis. If your basis was already down to $1 and you get a $2 return of capital, then $1 would be a taxable capital gain, but typically it just reduces basis.
That's a huge difference from treating it as a regular dividend.
Absolutely massive. Mistakenly reporting return of capital, Box 3, as ordinary dividends, Box 1A on Schedule B is a common error that causes people to overpay taxes significantly.
Wow. So the lesson here is read your 1099 DIV carefully. Only the ordinary dividends from Box 1A actually belong on Schedule B, Part 2.
Precisely.
Qualified dividends in Box 1B affect your tax rate on Form 1040. Capital gain distributions in Box 2A go to Schedule D. And return of capital in Box 3 reduces your basis and usually isn't taxed right away.
You've got it. Understanding those distinctions is critical for accurate reporting and, frankly, for effective tax planning around your investments. It ensures you pay the right amount of tax and take advantage of those lower rates when applicable.
So while Part 2 of Schedule B itself might seem simple, basically, line 5 for ordinary dividends and the nominee adjustment, the context around that 1099 DIV is really important. Remembering the nominee rule stops you from paying tax on someone else's income, and understanding the other boxes stops you from paying the wrong kind of tax, or paying tax when you don't even need to yet.
Well put. It reinforces that theme. Knowledge is power when it comes to tax forms.
Okay, let's shift gears now to Part 3 of Schedule B. This is the section that deals with foreign accounts and trusts. And you mentioned earlier, this part feels different. Less about calculating income, more about disclosure and potentially serious consequences if you miss something.
That's exactly right. Part 3 is heavily focused on compliance and transparency. The IRS and the Treasury Department are extremely serious about tracking international financial activity. Messing up here can lead to penalties that are, frankly, frightening.
Okay, setting the stage there. So what's the first thing we need to know about this section?
Before we even get to the questions on Schedule B itself, you need to be aware of Form 8938, Statement of Specified Foreign Financial Assets.
Another form.
Yes, and this one might be required even if you don't meet the threshold for the other big foreign reporting form, the FBR, FinCEN Form 114, which we'll get to. Form 8938 gets filed with your tax return if the total value of your specified foreign assets exceeds certain thresholds, which vary based on your filing status and whether you live abroad.
And if I'm supposed to file Form 8938, but I don't.
Significant penalties. Failure to file penalties can start at $10,000 and go up. But maybe even more concerning is that if you fail to file it when required, the statute of limitations for the IRS to audit your return related to those foreign assets can remain open indefinitely.
Wow, not just 3 or 6 years, but forever.
Potentially, yes.
Okay.
It underscores how seriously they take this disclosure. Ignorance really isn't a defense here. So step 1 is figuring out if you need Form 8938.
Okay, duly noted. Now let's look at Schedule B, Part 3 itself, line 7A, question 1. It asks about having a financial interest or signature authority over a foreign financial account. Sounds broad.
It is very broad. You have to check yes here. If at any time during 2024 you had either a financial interest in or signature authority over a financial account located in a foreign country, note that you check yes here even if you aren't required to file the FBAR form we mentioned. This question on Schedule B is a separate check.
Okay, we need to break down those terms. What counts as a financial account? Is it just a bank account?
Oh, much broader than that. Yes, it includes savings accounts, checking accounts, time deposits, but also securities accounts, brokerage accounts, commodity futures, or options accounts. Crucially, it can also include things like an insurance policy with cash value or an annuity policy with cash value if held at a foreign institution. Even shares in a foreign mutual fund count.
Okay, so pretty much any way you can hold financial assets abroad. And what defines located in a foreign country? What if it's a U.S. bank, but the branch is overseas?
Great question. The physical location of the account matters, not the nationality of the bank. So yes, an account at a branch of, say, Citibank that's physically located in Paris is a foreign financial account.
Okay.
But an account at a branch of, say, Barclays Bank that's physically located in New York City is not considered a foreign financial account for this purpose. Location, location, location.
Got it. Physical location is key. Now, signature authority, does that just mean I own the account?
Not necessarily. Signature authority means you have the power, acting alone or with someone else, to control the disposition of the assets in the account. You can do this by communicating directly with the foreign financial institution.
So if I can tell the foreign bank to wire money out, even if the account isn't technically in my name?
That likely means you have signature authority. Maybe you manage accounts for an elderly parent living abroad, or you're an officer of a company with foreign accounts you can control. And here's a nuance. Some exceptions that might apply for signature authority when filing the FBAR do not apply to this specific question on Schedule B. So even if an FBAR exception covers you, you might still need to check yes on Schedule B, line 7A, question 1, based on this broader definition.
Okay, that's a tricky distinction. So answer question 1 carefully based on that broad definition. Now, question 2 on line 7A asks specifically about needing to file FinCEN Form 114, the FBAR.
Correct. This is where you indicate whether you actually have the separate FBAR filing requirement. You check yes if you do, no if you don't.
And what triggers the FBAR requirement? You mentioned a dollar threshold.
Yes, the trigger is if the aggregate value of all your foreign financial accounts combined exceeded $10,000 at any point during the calendar year.
Aggregate value, meaning add them all up.
Yes, add up the highest value each foreign account reached during the year. If that combined peak value tops $10,000, even just for one day.
Then I have to file the FBAR. That's a surprisingly low threshold, given the penalties.
It is relatively low, and it catches many people, especially expats or those with family or investments overseas. And remember, that list of what counts as an account is broad.
And you stressed this before. The FBAR is not filed with my tax return.
Absolutely critical reminder. FinCEN Form 114 must be filed electronically, separate from your tax return, directly with the Treasury's Financial Crimes Enforcement Network, or FinCEN. You use their online BSA e-filing system.
When does it due?
The official due date is April 15th, same as taxes, but there's an automatic extension to October 15th. Always best to check the official fincen.gov website for the current year's deadlines and details. Filing it late, or not at all, is where those severe penalties kick in.
Okay, let's talk about those penalties again,
Yeah.
because they sound serious. What happens if I just forget or didn't know? A non-willful mistake.
Even for a non-willful violation, an honest mistake, the civil penalty can be up to $10,000 per violation, and a violation could potentially be assessed for each account not properly reported for each year.
Wow, $10 even for an accident. And if the IRS decides it was willful, like I knew I should report and deliberately didn't.
Then the penalties become draconian. The civil penalty for willful failure to file can be the greater of $100,000 or 50% of the total balance in the unreported foreign accounts at the time of the violation.
60% of the account balance.
Yes, per year. And that's just the civil penalty. Willful violations can also lead to criminal charges, potentially involving prison time and even larger fines.
Okay, those are truly staggering penalties. It really makes you ask why. Why is the government so incredibly strict about reporting these foreign accounts? What's the bigger picture here?
It's a great question. The severity reflects major government priorities that go way beyond just collecting income tax. It's about combating money laundering, tracking funds used for terrorism financing and other illicit activities, and ensuring overall transparency in the global financial system. After 9/11 and the 2008 financial crisis, there was a huge push globally to prevent the financial system from being abused. The FBAR and related rules like ASIA, Foreign Account Tax Compliance Act, are key tools for the U.S. in those efforts. They need visibility into where money is flowing internationally to protect national security and financial stability.
Okay, that context helps understand the why behind the severity. It's about much more than just individual tax compliance.
Exactly. The penalties are designed to be a powerful deterrent because the stakes, from the government's perspective, are very high.
Okay, so back to Schedule B. If I checked yes to question 2 on line 7A, meaning I do have an FBAR filing requirement, what's next on the form?
Then on line 7B, you simply need to list the name of the foreign country or countries where you hold these financial accounts. If you have accounts in, say, Canada and Germany, you'd write Canada, Germany. If you ran out of space, just attach a statement.
Straightforward enough. Now, the last line in Part 3 is line 8, about foreign trusts. This sounds like another specialized area.
It is, and it carries its own significant reporting requirements and potential penalties. You need to pay attention to line 8 if you were involved with a foreign trust in certain ways during the year.
Like what?
2 main triggers here. First, if you received a distribution from a foreign trust, and be aware, even receiving a loan of cash or marketable securities from a foreign trust is often treated as a distribution for this purpose.
Okay, receiving money or assets from a foreign trust.
Second, if you were the grantor of or a transfer to a foreign trust that existed during 2024. Basically, if you created the trust or put assets into it.
If either of those applies, what do I need to do?
You likely need to file Form 3520, Annual Return to Report Transactions with Foreign Trusts, and receipt of certain foreign gifts. This form provides the IRS with detailed information about your relationship and transactions with the foreign trust.
And let me guess, this form is also filed separately from my main tax return.
You got it. Form 3520 is not attached to your Form 1040. You file it separately by mail to the address listed in the Form 3520 instructions. Missing this filing deadline can also result in significant penalties.
Okay, separate filing for Form 3520 Any other related forms for foreign trusts?
Yes, there's also Form 3520A, Annual Information Return of Foreign Trust with a U.S. owner. If you are considered the U.S. owner of a foreign trust under the grantor trust rules, meaning you essentially control it for tax purposes, you are responsible for ensuring that the trust files Form 3520A with the IRS.
So that's an obligation on me to make sure the trust itself files something.
Correct. The due date for Form 3520A is generally March 15th for a calendar year trust, a month before regular taxes. Failure to ensure this form is filed can also lead to penalties for you, the U.S. owner.
Wow. Foreign trusts sound like they require very careful handling and professional advice.
Absolutely. The rules are complex, the reporting is extensive, and the penalties for noncompliance are substantial. If you have any dealings with foreign trusts, seeking expert advice is highly recommended.
Okay, so part 3, this whole section on foreign accounts and trusts, it really does feel like a different league. It's not just about listing income, it's about critical disclosure, separate forms like the FBAR and Form 3520, and avoiding potentially life-changing penalties.
That's the perfect summary. It highlights the global nature of finance today and the IRS's intense focus on ensuring U.S. persons meet their international reporting obligations. Compliance here is non-negotiable.
It really shows how your personal tax responsibilities are deeply connected to these bigger issues of global finance and security. Definitely not something to take lightly. Hashtag outro. So let's wrap this up. We've really gone deep today, unpacking Schedule B from top to bottom. We covered the basics of when you need it, the details of reporting interest and dividends in Parts 1 and 2, and crucially, those often missed adjustments like for nominee income or bond premiums or the savings bond exclusion that can actually lower your taxable income. And then we navigated the very serious waters of Part 3, covering the critical compliance rules for foreign accounts and trusts, where accurate reporting is just paramount.
It's a lot to cover, definitely.
Yeah, and look, the goal here wasn't to make everyone a tax accountant overnight.
Yeah.
Far from it. It was really about equipping you, our listener, with the knowledge to look at Schedule B and your related tax documents with more confidence, to understand the why behind the lines, and to spot those opportunities where you can strategically and legally ensure you're paying only what you owe.
Exactly. And if we connect this back to the bigger picture, being accurate and informed on your tax return, understanding these specific rules, it's not just about avoiding trouble with the IRS. It's really about having a clearer understanding of your entire financial situation, how your investments generate income, how different assets are treated, where your money is globally.
That's true. It forces you to look closer.
It does. Which leads to maybe a final thought or question for you to consider. Now that you have this deeper insight into a form like Schedule B, how might that knowledge empower you? How could it help you make more informed decisions about your finances, not just when you file your taxes once a year, but throughout the entire year? Could it change how you structure things or where you save?
That's a really powerful question to end on. Thinking beyond just tax season. Remember, everyone, being well-informed is probably your most valuable asset when dealing with finances and taxes. We hope this deep dive into Schedule B has armed you with some surprising facts, some clear insights, and definitely some actionable knowledge.
Hopefully making it a little less daunting.
Exactly. So you can navigate reporting your interest, dividends, and especially those foreign accounts with much more confidence. Until next time, keep learning, keep asking questions.
And keep deep diving.